You say one of the major risks is, in fact, in credit markets.
Absolutely. We look at the debt markets right now, and we have $600 billion of corporate debt with negative yields, which is an amazing thought process, right? If 10 years ago you said corporate debt could have negative yields, people would say there's no possible way. So really, it is pushing people into the equity market as a no other alternative that's out there. But really, the equity market as well is being driven by the cheap debt because the corporate buybacks of equity have been substantial. So if you look at like Citigroup that reported, Citi said they grew 12 or 13%, but in reality, you take out the tax cut plus the corporate buyback, their earnings are flat. So I think it's all being driven right now by debt and cheap debt, and it could go on for a while more, but certainly there are implications to that.
Exactly. Now, that's been the case for a while. So what happens when the Fed, as is really pretty much the consensus expectation now, drops the rate by 25 basis points?
I think there are two things going on. They're pushing on a string right now from an economic standpoint. So if you look at what's happened in Japan the last 20 years, you look at what's going on in Europe as well, they haven't been able to increase their economic output just because they've lowered interest rates. I think we're getting into that trap as well. So we'll lower interest rates, but all we're doing is having financial assets continue to go higher, which is bifurcating the world as well. So the people who own stock, and there's only 52% of the country right now own stock, are going to do well because of that. But still, you have a substantial amount of people that aren't doing well, and eventually they're going to demand higher wages. And we're starting to see higher wages right now, especially in the UK, starting to see it in Europe as well, and the US, where it's 3% plus, that if productivity gains don't continue to go up, you're going to have some inflationary pressure from the bottom, which is then going to cause bond investors to be a little bit more concerned, inevitably, which means you'll have higher rates.
Except that's what we've been waiting for so long, right? And the Fed Chair, Jay Powell, literally just a few minutes ago saying in France that there is increased uncertainties.
There's absolutely increased uncertainties. And I think part of the issue as you came out of what happened in 2007 and the issues that were there, it took a while to heal the marketplace. But you're starting to see some wage pressure at the bottom. You're seeing financial assets continue to go up at the top, which is putting pressure. And the middle class has really been stagnant for the last 20 years. So as we look at low unemployment, again, we're looking at the Phillips curve, and everyone thinks it's dead. I don't think it's dead. It's just very dormant. But as you continue to push lower, then all of a sudden that employment group will look for higher wages. And I think they're starting to see some gains.
So at what point do we get something toppling, which then, as if I follow your argument correctly, would, sort of have a domino effect on other asset classes? Where does it begin, too? Is it the leveraged loan
That's
area?
the great unknown, right? So certainly the leveraged loans are a place where they usually are par or substantially less because no one really marks them to market, right? So if they're performing, it's okay. So I think the commercial mortgage space has some issues as well. So you're seeing a toppiness there, especially at cap rates. You're seeing it in the leveraged loan space. It's covenant light, so there's issues there. Tops can go on for a while. The problem is when you're looking at your capital and how to deploy it, you want to make sure you don't take undue risk for the return you're getting. Clearly, right now in the debt market, you're taking way too much risk for the opportunity and the return you're getting.